Well, you have hit upon one of my central beliefs about charting, and it goes right to the core of how I understand charts and how to use charts to make money in the markets. There is no one timescale. To get a complete understanding of what's going on in the markets, you need to look at a series of timescales, and typically you'd start from the longest possible timescale that you can get information for of any one market you're interested in trading, and then you would take successive snapshots of that market, starting, say, for example, with a quarterly bar chart, a weekly bar chart, a daily bar chart, conceivably an hourly bar chart. But to build a complete picture of the market, no matter what your time horizon of trading, you need to know have all those images in your head, because each one of those separate charts will have a different series of patterns and trends, and they will be impacting on the market wherever you're trading it and however short you're trading it, and you need to know all those influences to build up a whole picture. So what seems to be a simple way of analysing the market, which is bar charting, classical bar charting using volume, open interest, high, low, close, turns out to be a very much more complex animal when you use multiple time horizon analysis. What we're talking about here is understanding the importance of recognizing that there are patterns within patterns, there are trends within trends, and to grasp that notion goes to the very heart of using charts successfully for your trading. Fractals is basically the notion that typically in crystalline structures, that the same structure can be found as you expand your view of a piece of matter or crystal, no matter how small you get and how wide you get, so that you see the same structures. It's a uniform repetition of its smaller self. So the micro view of a piece of crystal reveals the same structure as the macro view. You can see a pattern on the big scale that you may not see replicated on the smaller scale. Understanding the forces at work, the technical forces at work on a market at any one time, means to understand the possibility that though there's a bull pattern operating on the market in the day chart, there may be a bear pattern operating on that market in the week chart. And therefore you have to understand the two forces are pressing against each other or opposed to each other, and the trader's judgment then has to be used as to which is the bigger of the two, which is more influence at moment to moment. I think you have to recognize that beginning is difficult. It's like beginning to play the piano. You can't play beautiful tunes straight away. And I think you should understand trading in the same way. You can play very, very simple tunes. They won't be as satisfying, and they won't wow the audience, if you like, or your bank account in the same way as a more complex tune. And I think one should tailor one's ambitions according to the experience. Obviously, you've got to start somewhere. I would start at a daily bar chart. I would get to know how daily bar charts work, how patterns form, break down and complete, how trends form and break down and complete. I would look at that bar chart and I would put it in by hand. I would stand to one side from electronic charting initially, and I would learn my charting by doing it by hand. There's no better way of understanding what's going on in the market than hand writing your charts, and a daily bar chart is an obvious place to start. Very quickly though, I wouldn't be trading on my daily bar chart. I would be just plotting it, and I'd probably do several daily bar charts. I'd plot them all, and then I would look to gradually expand my horizon, probably electronically, by looking at weekly bar charts and monthly bar charts as well.